Hi, I'm Lauren Mason. I'm joined today by David Keir, co-manager of the Saracen Global Income Growth Fund. Thank you for joining me today.
No worries, good afternoon.
David, what is your outlook for global equities as we move through the rest of the year?
Yeah, well, I think we're at a very interesting time. Obviously, we're a very strong start in January, but obviously since then, with volatility spike up, with some sort of geopolitical macro concerns. But actually, the way we see things is the markets pull back, finding a lot of opportunities to reinvest in the market. And we're actually finding a lot of opportunities in Europe at the moment, and some of the more cyclical parts of the market. We still think the bond proxies are a little bit overvalued and expensive and too early to buy into, but we continue to find much more value in more cyclical parts of the market. And actually, things like Europe are actually trading at a discount on a price-earnings ratio to their long-term average, and actually trading on a dividend yield above their long-term average. So we're still finding lots of opportunities for the long-term investor.
And of course, dividends are a key component of the fund. Where in the world are you seeing the best dividend opportunities at the moment?
Well, we've actually been pleasantly surprised by the results we had with the full year end 2017. A lot of our companies actually delivered stronger dividend growth than we expected. Actually, some of the financials companies, for example, DBS, had 50% increase in dividend, and Handelsbanken had a strong increase in dividend and also gives a special dividend on top. So actually, and some of our US tech companies, Cisco announced a much higher, better dividend than expected, and it's a share buyback. So it's been across the globe. But this actually ties into some of our more cyclical positioning in the portfolio, because some of the more cyclical names, for example, Heidelberg Cement has increased its dividend by 18% with its full year results, and we expect that dividend to grow materially from these levels as well.
And would it be okay to go into more detail about your investment process and perhaps give another example of a stock you particularly like at the moment?
You know, we take a very long-term view at Saracen with all three funds, and what we're trying to do is identify global leading businesses that are able to grow their sales over the long term, because we think the best way of getting dividend growth is to get companies that can grow their sales, grow their profits, grow their earnings, and ultimately their dividends. So we're trying to identify these global leading businesses, but the key for us is to buy them when they're cheap with supportive dividend yields. So that's the key part of the process. And a good example of a stock that we can buy more of actually is Heidelberg Cement, and that's one of these businesses which is a more cyclical business, listed in Europe, but the price earnings ratio has fallen to sort of 12 times current year earnings, and the dividend yield is 3%, and the balance sheet is very, very strong. And actually, we think that earnings can grow materially from here through a combination of a recovery in European earnings, North American growth continues, and also long-term structural growth in emerging markets. At the same time, we've got expensive debt to refinance, so we actually think there's a massive tailwind to earnings coming from the debt refinancing, underlying market growth, and that should lead to good earnings growth, very strong growth in dividend, and we hope a re-rating on a higher earnings number.
Okay. David, thank you very much.
Thank you.